Hi everyone and welcome to LWC1 Business Law and Ethics webinar on Sarbanes-Oxley Law, otherwise known as SOX. So the objective tonight is to familiarize you with Sarbanes-Oxley Law, specifically why we have this law, and we will cover what you need to know to pass this section of the assessment and pre-assessment. First of all, that's me on your screen. My name is Martin Connor, and that's my phone number and that's my email. So please feel free to contact me at any time with questions about LWC1. I'm going to scroll back to the beginning of this PowerPoint. Have you heard of the MF Global case? Well, MF Global is an ongoing case. There was a bankruptcy last year, and this was a small trading company that invested heavily, well, really bet heavily on the euro coming back. The euro didn't come back, and they lost a lot of money and slid into bankruptcy. What makes this case interesting is two things. Number one, just before they slid into bankruptcy, over $1 billion of client money got placed into the corporate fund area and went missing. In fact, it was used to cover debts of the corporation, and that's a big no-no. And the other interesting part of this is that the CEO at the time was John Corzine, who is a former Democratic senator from New Jersey and former Democratic governor of New Jersey. And he was in the Senate at the time that Sarbanes-Oxley law was passed. So it's going to be interesting to see if this law will cover this kind of action done under the tenure of a CEO, even if the CEO did not actually know whether the funds were being transferred or not. As you will see, one aspect of Sarbanes-Oxley law is to try to make sure that the highest level people at the highest levels of the corporation cannot just say they didn't know what was going on and therefore they don't have any responsibility for any kind of actions that went on that tripped the Sarbanes-Oxley law. Well, what is SOX? Sarbanes-Oxley Act was passed in 2002, and it provides federal oversight of corporate accounting. It applies to all publicly traded corporations based in the U.S., right now at least if they have over $75 million in gross revenue. It also applies to all foreign companies listed on the U.S. Stock Exchange. So we're talking about, for the most part, large publicly traded corporations. And Sarbanes-Oxley law provides federal oversight of the accounting within those corporations. So why do we have SOX? Well, it's a response to the corporate scandals, if you remember some of those, particularly in the 1990s. Scandals such as WorldCom and Enron. And so in response, Congress passed Sarbanes-Oxley law, and it created the Public Company Accounting Oversight Board. This is a board that monitors firms that audit public corporations. So this board sets standards and rules for auditors of public corporations. Because back in the day, the auditing corporations, such as Arthur Andersen Company, were auditing these large corporations, but they weren't being honest about it. So this new law, Sarbanes-Oxley law, created a new Public Company Accounting Oversight Board, which establishes standards and rules for those auditors. The board has both investigatory and disciplinary power over the analysts and auditors who issue reports about these large publicly traded corporations. So in other words, these auditing firms have to follow the rules, and they have to make sure that what they report about a corporation is accurate and above board. Sarbanes-Oxley law also works within the corporations themselves. It requires CFOs, that is Chief Financial Officers, and CEOs, Chief Executive Officers, to certify financial statements. So in other words, if the corporation issues a statement about their finances to the SEC or to the public in general, they have to sign off on that and attest that not only is it accurate, but that the accounting standards that we use to reach those conclusions within that financial statement followed the new laws within Sarbanes-Oxley. It requires audit committees with independent members. In other words, people with no financial interest in the company. These committees sit within the corporation, though, and they try to make sure that the accounting standards used within the corporation comply with the strictest laws that the U.S. has. It also disallows loans by corporations to board members or officers of the corporation. The idea there is to tamp down on the inside dealing that was going on in the past when the freewheeling deals were made, which benefit certain people to the detriment of others. So SOX requires each corporation to register a code of ethics for officers with the SEC. And the reason behind this is so that the SEC can say if something goes wrong that the higher officers should have known or what to do and how to do it in terms of their financial accounting standards. So that the higher ups cannot say, well, we didn't know what was going on, or we tried to comply with the law, but we didn't know how to do it, something like that. In the end, what it's really trying to do is make sure that the highest levels of the corporation are responsible for everything that goes on within the corporation. It also requires that accounting firms cannot provide both auditing and consulting services to a single client. Now, you can get exceptions to that, but for the most part, the idea is that these accounting firms that audit the large corporations don't have a built-in bias, because what happened in the past was you had these accounting firms getting contracts worth millions of dollars to audit a corporation. And the corporation would say, gee, we really hope that this audit looks good, because if it does, we're going to have some consulting service contracts to let. And wouldn't you like to have a few $1 million on consulting contracts? And so the auditing corporations would make the corporation look good, even if it really was not on solid financial footing. And SOX requires attorneys to report wrongdoing to managers and to board of directors if necessary. Now note that this does not allow the attorneys to report wrongdoing outside the corporation because of the duty of confidentiality. But it does tap into that duty of confidentiality just a little bit and require them to report wrongdoing to managers and to board of directors if necessary. But note that is within the corporation, not outside the corporation. So SOX provides protection for whistleblowers. There are other federal statutes that protect whistleblowers, but SOX has one specific to blowing the whistle on financial wrongdoing. It also requires that financial analysts certify recommendations about the corporation are based on objective info. So in other words, these guys who are out there saying buy, sell, or hold have to certify with the SEC that their recommendations are based on objective info. They're not basing it on some sort of inside information that's going on in the corporation that is not reported to the public. And finally, and this is an important one, it requires revolving auditors that move from one account to another over time. So after about 6 years, auditors have to move from one account within the corporation to another one. They can't stay on that same account. And the reasoning behind that is so that there is no collusion between the auditing corporation and the corporation itself, such that they decide to get together and say everything looks great, even though it isn't. So after about 6 years, auditors have to move from one account to another. So is Sarbanes-Oxley law too costly? Well, many people within the business world think it is, especially corporations and the CEOs and the powers that be within those corporations. According to our textbook, Business Ethics, the cost of compliance with Sarbanes-Oxley is about $1 million per $1 billion in revenue. So that's really a lot of money, actually. $1 million in compliance costs for every $1 billion in gross revenue. But a lot of people actually say it's quite a bit higher than that. Some claim that the costs have caused companies not to list with the SEC and to delist from the stock exchange. To not list with the stock exchange or to delist from the stock exchange. Simply because they don't want to be a publicly traded corporation in the U.S. They don't want to pay that price for compliance with Sarbanes-Oxley. Others say that some startup companies have not taken off because the demands of SOX is too great or just is unknown to them how much they're going to have to pay to comply with Sarbanes-Oxley law. And really there's a huge cottage industry has grown up around the idea that these corporations come in and they tell you how to comply with Sarbanes-Oxley law. So it's become really a big business just to comply with this single law. So because of that, many people think that Congress will change Sarbanes-Oxley law after the election sometime next year. They probably will make the exceptions for the size of the corporation larger. Probably if you have a corporation with $150 million or so gross revenue, you will be accepted from Sarbanes-Oxley law, or at least some of the burdens of Sarbanes-Oxley law after next year. But that will probably not happen until after the election. So is it effective? Well, there definitely have been some burned investors since Sarbanes-Oxley law was passed. And there's reasons for that. Probably the main one is simply that even if you make something illegal, it doesn't mean that people are going to stop doing it. Just because burglary is illegal doesn't mean that you can stop all burglaries. But hopefully this law has tamped down on some of the misconduct that was going on in the corporations. Hopefully it has tightened the accounting standards so that people can better rely on statements from the corporations and from auditors. And hopefully it has just made some people who might have been tempted to try something funny to not do it. Of course, it's really hard to determine how many people did not commit a crime because of this law. So how effective it is, it's hard to say. Currently, we have the MF Global case going on, and it's a fun one to watch. Keep an eye on that to see if the CEO, who claims he did not know anything about the transfer of the client funds out of the client accounts into the corporate accounts, is tapped for that responsibility anyway, being the CEO of the corporation. So that's it in a nutshell. That's what you need to know about Sarbanes-Oxley law to pass the pre-assessment and the assessment. Both books do a great job of covering the law, and there's a lot of information on the web as well. That's me. That's my email address, mconnor1@wgu.edu, and that's my phone number there. Feel free to get in contact with me if you have any questions or concerns. Thank you for coming. I appreciate it, and good night.